Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane, I'ma do it all for you.
Everyone, welcome back to the channel. We're back with another watch list and plays, but first let's take a look at the latest in the financial markets and some key updates you need to know about. Starting off, the equity markets ended the day on a positive note, with growth-style stocks outperforming value-style stocks. This came after Fed Chair Powell gave a speech indicating a somewhat dovish tone and suggesting that inflation has started to ease. On the bond side, yields did rise slightly, with the 10-year Treasury moving above 3.65%, but oil markets saw a boost, with oil finishing the day around $77 per barrel, up by over 4% from the previous session. However, earnings continue to be a mixed bag, with fewer companies exceeding analyst estimates and analysts starting to downgrade earnings estimates for the first quarter. The biggest issues for companies seem to be persistent input pricing pressures and slowing consumer demand. But there are a few bright spots, with cost-cutting initiatives and lower supply chain constraints allowing for inventory rebuilding efforts to continue. And finally, it's important to keep an eye on the Fed, as they remain the key driver of the markets in the near to medium term. Today, Fed Chair Powell reiterated the commitment to combating inflation, but also indicated that it's easing, and that further rate hikes may be necessary if labor market strength continues to come in above expectations. We also have a few more Fed speakers this week, so be on the watch for a market dips and pops. It could be choppy. Now that we got the recap out of the way, let's get into the plays. First play, Amazon. If you've been following the stock, you know it's been a wild ride, with shares down 35% in the past 12 months. But here's why I think now could be a great time to buy the dip on Amazon. First, the macroeconomic conditions could be improving soon. With inflation slowing down, the Federal Reserve might ease off its restrictive monetary policy, which would be great news for growth-oriented stocks like Amazon. This would mean investors might be willing to pay a premium for Amazon's future earnings and cash flow without the risk of a recession. Second, Amazon is a cyclical company. The recent dip in the stock price could be due to the company's performance during the fourth quarter of 2022, which showed a 98% drop in net income, but we need to remember that Amazon's business is highly sensitive to changes in macroeconomic conditions. Over the long term, e-commerce and cloud computing remain growth opportunities for Amazon, and the company is expected to roll out its e-commerce platform in Latin America and Africa this year. Plus, Amazon's scale gives it a cost advantage over its competitors, and it's worth noting that the company is lagging compared to other big tech companies in the Nasdaq index. So, those are my two reasons why now could be a great time to buy the dip on Amazon. Based on those two factors, I picked up more shares of Amazon after Powell's speech and will add a bit more on the dips. Next up is Lyft. I will be playing this as a sympathy to Uber, which reports tomorrow mornings. Lyft is expected to release its earnings report for the quarter ended December 2022 on February 9th, and the market is anticipating a year-over-year increase in earnings, driven by higher revenues. The stock price may rise if the earnings and revenue numbers surpass the estimates. As of now, the consensus earnings per share, EPS, estimate for the quarter is 10 cents, which represents a year-over-year increase of 11.1%. Revenues are expected to be $1.16 billion, a 19.3% increase from the same quarter the previous year. The consensus EPS estimate for the quarter has been revised downward by 0.76% over the past 30 days, reflecting the revision of estimates by the covering analysts. For Lyft, the most accurate estimate is higher than the consensus estimate, resulting in an earnings ESP of plus 42.37%. Additionally, the stock has a rank of buy. This combination suggests that Lyft is likely to beat the consensus EPS estimate. It is also important to take into consideration a company's earnings surprise history when calculating future earnings estimates. In the last reported quarter, Lyft produced earnings of 11 cents per share, beating the expected earnings of 8 cents by 37.50%. Over the past 4 quarters, the company has exceeded consensus EPS estimates 3 times. In conclusion, Lyft appears to be a promising candidate for an earnings beat based on its positive earnings ESP and rank. Lyft's recent cost-cutting provide meaningful opportunity for the company to improve its earnings over the course of this year. Lyft calls are fairly inexpensive. I will be looking at 18 call with February 17th expiration. So there you have it, a quick rundown of what's happening in the financial world in a few plays. As always, stay informed and make informed decisions. Subscribe, like the video, and comment your thoughts, watchlist, concerns. Let me know in the comments if you agree or disagree. I'll catch you on the next one.